Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, we're going to go over two articles that give a very good explanation as to why interest rates are not having that big of an effect on the housing market. Likely will not have that big of effect on the housing market in the near amount of time in the short term. And probably by the time they are able to have an effect, probably won't matter. Okay?
Okay.
And what we're going to do is when we go to the article, we'll talk about these things. There's two different articles. How's that sound?
Sounds fascinating.
Fascinating. Okay. So here's the first one. This is from Black Knight. They have their own report and they do a bunch of data. Home prices in the U.S. reach record highs for the fourth consecutive month in August. Now this article just came out, but they're looking back at adjusted August numbers. Home prices increased at a seasonally adjusted rate of 0.68%. We have actually more specific numbers in there, but 4 months in a row of home price increases with interest rates the highest they have been in over 20 years.
That sounds so pleasant if you're a borrower, doesn't it?
Yeah. Okay.
So let me get this straight. Home prices are increasing. Interest rates are increasing. Woohoo. If you're a buyer, you're sitting there going, yeah, I'm so, yeah.
Yeah. All right. So here's the next one. Compared to August 2022 figures, home prices increased by 3.8% year over year. Now remember, August of 2022, you could still get 5.8%. I don't think interest rates had hit 6% yet.
No. Well,
they're almost 2% higher than they were. But home prices are still 3.8% more year over year. May and June, they grew 0.25 and 2.4%. respectively. This is kind of, if you had told people a year ago in August, when home prices were, tapering off quite a bit because of seasonality, which happens every year, but then they were a little bit more because interest rates had gone up, right? And then some people panic sold, right? There were some people just, I'm going to get out of this house because it's going to crash, right? And they sold their house. That interest rates would be 2% higher. And what would home prices be? They would probably all say, oh, that's probably 30% less, right? They'd have picked a big number. But in actuality, 3.8% increase.
Right.
Seems counterintuitive.
It does until you consider the elephant in the room.
What's the elephant in the room?
No inventory.
There's, supply and demand, right?
Absolutely. So that's what's driving home price stability or increases depending on where your market is. That's what's driving it. The lack of inventory is giving a lot of support to the housing market. And you're seeing that particularly in resale, but you're also seeing it in new home. I know that new home builders, they came out with the new home builder sentiment that they're feeling less confident. They have less of the warm and fuzzies about the market going forward, and they're pulling back on the number of homes they're building. But remember, when they're pulling back on the number of homes they're building, they are contributing to all of this, right? Because they're bringing less homes to market. Again, diminished inventory, supply and demand. That's just pushing prices up.
And that actually is, remember, they probably have to build 1.5 million houses a year for a decade just to catch up. And I think this year they're going to build 700,000 or 800,000. And they are impacted by these interest rates too, borrowing costs. But for two reasons. One is they have to borrow money to build all this stuff. They don't just have a ton of cash, right? And then the second reason is because their customers are having to borrow money to buy. So it's choking off a little demand. So they're like, we'll just back off and we won't build as many homes. We'll build just enough homes to be profitable. But I can tell you this, and then we'll get back on with this. If you're a home builder and I told you there was a certain number of homes you would build that would maximize your total profit, you would build that number of homes, period. That's all you would do. If I said, KB Homes, you have to build 18,000 homes in the entire US next year, and this will maximize your profit. That'll be the most profit you can get. Because if you build more, your profit will actually be less. And if you build your profit margin. And if you build less, your profit will be less. So this is the number. They build exactly that many homes. They don't care if they need to build twice as many. They would just build that number, right? Okay.
So look, home builders are not building according to what the market needs. They're building according to what their business plan dictates is in their best interest.
If interest rates were under 3% right now, home builders would be doing everything they could to put as many houses on the market because people would be able to buy them easily. They would be able to finance their end of it, buying all the materials, the land, and everything. They would probably be building like crazy.
Right. So in this environment, you are seeing a pullback from the home builders, except not all home builders. So when you're looking at the luxury market, they're not pulling back because their customer is different. Their customer is more likely to pay cash. Their customer is less likely to be sensitive to interest rates. So they are actually looking at creating products for that customer. So that's a different situation. So when you're looking at this, understand that each segment of the market is a little bit different. And particularly when you compare non-adjacent segments of the market, there can be a substantial difference.
That's a very good analysis. Okay, we'll get through these next two. At the national level, home prices reached a new record for the fourth consecutive month and surpassed the 2022 peak by 2.5% on a seasonally adjusted basis. Home prices, the peak that we were told the home prices were going to fall 40 to 50% from the peak, or up 2.5%. Up 2.5% from the peak. And interest rates are probably higher than they predicted they would be.
I'm sure. I mean, even you and I think, are surprised to see interest rates flirt with 8%.
Okay, here's the last thing for the article. As expected, mortgage origination activity was centered around purchase loans and is predicted to dominate the market next year. There were not a lot of refis. Most of the mortgages that were done were purchases.
Right.
Dominate the market next year. Okay, now, here is the last quote from this article, though we're going to talk about the next one because they're intertwined. Even though they're two different things, they have the exact same things in common, and we're going to talk about those. Andy Walden, Vice President of Enterprise Research at ICE, anticipates home prices to accelerate further and reach 5% annual growth rate by the end of this year. What do you think he's looking at?
He's looking at absolutely no supply. I mean, we just don't have homes coming on the market. The buyer demand is still strong. Interest rates don't matter as much when your buyer pool is so small.
So we read that article. We said, hey, we'll do a video about this. This is kind of the stuff we talk about. And then I read this other article that's much different, but then it has the exact same elements. So here it is. As per data released by Douglas Elliman and Miller Samuel, Manhattan's luxury apartment market is experiencing an inventory shortage. Despite broader apartment sales and prices facing challenges due to increasing interest rates, the scarcity is pushing prices further up. Right now, New York City has the highest apartment prices and the highest, and the prices to purchase are going up, but it's inventory shortage.
Right.
Okay. All right. Here's the next quote. Apartment sales in Manhattan, so purchasing them, were down 23% in quarter three, and the median average sale price held steady at 1.96 million and 1.15 million. Now, normally, if the number of sales are down, that means it's weak demand and prices are probably down, but the supply has fallen. So this equilibrium price, remember, supply and demand, where they meet is price. It's called price. And if you're at an equilibrium price, and that means that you're not in disequilibrium, which means you have a shortage or surplus, right? And there is no shortage or surplus. It's a pretty efficient market. So the idea of a bubble only happens if you have an inefficient market, right? But a market is still really efficient.
Right. So long as the market is efficient, then things should go pretty well as far as prices following the market. And, in this case, our market is efficient. What's happening is buyers that are less qualified are simply shut out of the market, and the buyers that are more qualified are, providing they can find a product that they'd like to purchase, are able to purchase because they are better qualified.
Jonathan Miller, CEO of Miller Samuel, highlighted that high-end buyers who often pay in cash are less sensitive to mortgage rates and have capitalized on attractive prices. So they're saying, hey, we've got a bunch of money. And we did a video about this where like all these Saudi and people from UAE were flooding New York City luxury, and they were buying up, they were parking cash basically. So they went to New York City to park a bunch of cash, and they were buying up all the luxury high rises. Remember that article we did? And because I think they saw that, because remember, prices fell when people left the city. They fell quite a bit. Mm-hmm. So people flooded in and said, hey, these are pretty good prices, let's buy them. But they don't care about interest rates.
Mm-hmm. No, because they're buying cash. And you can see that in a lot of markets. I don't know other markets obviously as well as I know Las Vegas, but you do see luxury home builders building a lot of spec homes, and these are homes that maybe start at 1.3 and they go maybe all the way to north of 5 million, and that's to start, not counting lot premiums, not counting, and these are not custom homes. These are track homes that they're not customizable, but they are personalizable. So what does that mean exactly? Well, you can make some changes, but not substantial changes, right? Their lot premiums are anywhere from starting around 100,000 and then, north of maybe 1 million. So there is a lot of room in the luxury market, not just in New York, but in other places in the country like Las Vegas. So that kind of tells you that there's a lot of money in the system, a lot of money. People are paying cash for these properties because they're looking, like you said, to park cash, but they're also looking at opportunities to own nice pieces of real estate.
He added that with a decrease in luxury condominium towers under construction, prices could rise further or remain strong. This is the same thing happening in the residential market. The builders have said, hey, it's expensive to build. We're not going to build that much. So this pushes people who would be coming into the market, forces back into the resale market, just like in housing, and it pushes up prices.
Right.
Because it affects demand. And then in the future, what does this mean? Right? Well, now you are short. You have a shortage. So when you have a shortage, prices go up.
Right. So the shortage is going to persist. And I think it's going to persist for a really long time. I don't really see the shortage getting better anywhere on the horizon, honestly, because unless builders are going to build a lot more, or unless there's some catastrophic event that kills off a significant portion of the population, we still have population growth, both through birth and through immigration. People have to live somewhere, so you still have a lot of demand. So what happens when people can't purchase? Well, they get to go out in the rental market. Well, the rental market for single-family homes is very limited. So now they're getting pushed out into apartments. The apartments are nicer than they used to be, but they're also more expensive than they used to be. So I think it's kind of a vicious cycle as far as interest rates. So you knew I'd come back to this, right? So what's happening is you have this kind of vicious cycle where real estate prices go up, rents go up, and home mortgages go up because inflation is persisting, because housing's expensive, and so it's just this kind of vicious cycle. Yeah. So you kind of have to look at it in context and understand that the off-ramp is not self-evident.
And the idea that, hey, real estate's just going to crash, well, then you could use this logic for everything. Gold is going to crash because too many people have bought gold and the price is not sustainable at that level. Gold's not backed by anything. It's just a piece. It's just a piece of metal. You can't live in it. Can't build a house out of it, right? Or crypto or stock market. No, it's only real estate that's going to crash. And I think the problem is there's too many people who view the market from the, you put 3% down and your payment is strictly based on what interest rates. They're highly sensitive to interest rates. If you're that buyer, you're shut out of this market. Mm-hmm. If you're not making a lot of money and you don't have a lot of money to put down, you're just shut out of the market. And in some markets that could affect housing negatively because there's less potential purchasers. But the idea is there's far more purchasers. We did an article, I think a year ago, that said in 2023, this is before 2023, there were 37 million people estimated, that it was about 10% of the country, that said they wanted to buy a house in 2023. Either buy another rental or buy a house. 37 million. We had like 3.5 million. So you only had 10% of the people, of all these people that wanted to buy, you only had 10%. So that percentage of people who were like at the low income, low down payment, they're gone, but the market doesn't need them. And I know it pisses people off. Why are you I'm just stating a fact. Like, the market doesn't care about you because you're not relevant to the market. Okay, you become relative to the market only when interest rates are low and when there's an excess of supply and they need you to come by, right? Then the interest rates are relevant. But until then, you're not relevant because, it's just like, I want to buy a Ferrari, so you need to drop the price to $40,000. Or I can't afford it. Like, it makes no sense. Why would I pay $200,000 for a Ferrari? That doesn't make any sense. It needs to be $40,000. Drop your price so I can buy it, right?
So there are going to be people out there telling you the Ferraris are more than $200,000, but okay.
Right. So our whole point here is, whatever you're thinking the inputs are to supply and demand, a lot of times people like to overemphasize the one input out of 20 things is the thing that matters. So I predict that we're going to see whatever interest rates do, it's not going to have the effect you think. Because everybody a year ago and all these doomers and, housing haters and the crash bros were all like, if interest rates go up, this whole party's over. And here we are, where we've exceeded the peak of 2022 prices with rates of, trying to push 8%. And in Vegas, the update we just did, home prices went up $2 a square foot in the last week. Right. So we'll see. Like, we'll keep tracking all this and talking about why things happen. But I just thought the articles were interesting. Even though they're sort of separate things, they illustrate the exact same points. Right.
And, what was interesting to me is that the things that were stated in the articles are the things that I'm actually seeing in the real world.
And but you're seeing only luxury homes. You're a broker at a luxury company.
Right. But what I'm saying is that what they're talking about in New York with the luxury apartments, I'm seeing that in Vegas with the luxury housing market.
Right.
So I see the similarities.
Do you know how many of those are purchased cash?
So that's a good question. I don't have solid numbers, but anecdotally, looking at our book of business, the majority.
Oh, wow. Okay.
So particularly once you get north of 3 million, that tends to be much more so. Once you get north of 5 million, that increases. So the higher the price point, the more likely it is it's cash.
Okay.
And you have to understand that it's not like somebody's writing a check for this, right? So what people are doing is, some people do have that cash parked and ready to go, but a lot of people are simply leveraging investment accounts and using that.
Okay.
So we certainly see that with like the $20+ million ones.
That's crazy.
Yeah.
I want $20 million for some of my rentals. I wonder how long it'll take before they're worth $20 million.
Not within your lifetime.
Not within my lifetime. Okay.
All right. So that was fun. Hope you guys had some fun. Tell us what's happening in your market, no matter what the market is, even if it's Vegas. Tell us what's happening in your neck of the woods. We're interested. Remember to leave us comments, like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.